Let's begin with a fundamental truth. When uncertainty reigns, gold doesn't whisper, it commands attention. In a world shaped by policy shifts, geopolitical tensions, and inflationary pressure, gold stands not just as a metal, but as a barometer of investor conviction. Today, we're not merely talking ETF. We're exploring how Singaporean investors can channel global macro insights through elegant, cost-efficient instruments. Welcome to Top Gold ETF to watch in Singapore for 2025. When you analyze gold as an asset class, you're not just looking at a shiny metal, you're looking at a centuries-old store of value that responds predictably to monetary debasement, geopolitical instability, and systemic risk. Now, when you want exposure to that kind of hedge, the vehicle you choose matters. It's not enough to say, "I want gold." You have to ask how you want to hold it, because the structure of the investment shapes the risk and the return. That's where SPDR Gold shares listed on the Singapore Exchange, both as 087 in USD and GSD in SGD, becomes important. It's not just a ticker, it's a portal, one that offers local investors direct access to physical gold without the frictions that typically burden precious metal investments. What makes this ETF unique is that it's structured to mirror the price of gold almost exactly. It's backed by allocated gold bullion held in London vaults, which means that when you hold a unit, you're not relying on derivatives, miners, or futures contracts. You're holding gold, indirectly, but precisely. The transparency of this structure is what builds trust. Investors know how much gold is held, where it's held, and that it's audited. That reduces counterparty risk, which in today's financial landscape is not just a feature, it's a necessity. The value of this ETF moves in close lockstep with spot gold prices, and that gives investors clarity in pricing and confidence in exposure. Then comes liquidity, which is often overlooked but absolutely critical. In volatile environments, you want to be able to enter and exit positions quickly, efficiently, and with minimal spread. SPDR Gold Shares has that. It trades with tight bid-ask spreads, both in the US and in Singapore, offering real-time market depth. The average investor doesn't always grasp how much liquidity contributes to performance, but over time, those fractional differences compound. Institutions understand this. That's why this ETF is favored not only by retail players, but by large institutions that need to move size without distorting market prices. Singaporean investors, in particular, benefit from its dual currency listing. You can trade it in SGD or USD, which provides an elegant way to manage currency exposure alongside the gold exposure. When you buy in SGD, you're gaining access to global gold prices without having to perform separate FX conversions. When you buy in USD, you're locking in dollar-denominated exposure, which becomes strategic when you're positioning around expectations for SGD depreciation or USD strength. That optionality, choosing your currency exposure within the same product, gives you a structural advantage. And in a world where currency volatility is no longer just a possibility, but a constant, having that degree of control is valuable. Let's talk cost. SPDR Gold Shares charges a 0.40% annual expense ratio. On the surface, that may seem higher than competing ETF like IAU or ESCAL, but context matters. You're not just paying for exposure, you're paying for structure, access, and robustness. The trade-off between expense ratio and trading friction often favors this ETF because of its size, liquidity, and ecosystem integration. The bid-ask spread is narrower, the volume is higher, the infrastructure is more developed. That means over time, especially for active investors or those with sizable allocations, The total cost of ownership may be lower than it appears on paper. This ETF also integrates well into diversified portfolios. Because it trades on SGX, it's easily accessible through most local brokerages, CPF investment scheme, and supplementary retirement accounts. That matters if you're managing long-term tax-advantaged accounts. You don't need to set up foreign brokerage links. You don't need to worry about U.S. estate tax exposure or withholding complications that sometimes come with U.S. domiciled funds. It's clean, simple, and local, with global exposure. That combination is rare, and when you see it, you don't dismiss it. You allocate to it. What makes this structure so effective is that it respects the fundamentals of sound investing. It minimizes unnecessary complexity. It provides price fidelity, it delivers liquidity, and it gives you control. In a time when asset classes are increasingly interlinked and fragilities lie beneath the surface of seemingly stable systems, having an asset that sits outside the traditional financial plumbing and an instrument that gives you efficient access to that asset is a core building block of portfolio resilience, and that's the real point here. You're not just investing in gold. You're investing in a structural advantage, one that reduces friction, provides transparency, and aligns with the broader macro reality we're living in. That's how you prepare for what's ahead, not by guessing, but by structuring wisely. When you think about long-term investing, real risk-adjusted value-preserving investing, the conversation must go deeper than price action or short-term momentum. It must turn to structure, to cost, to the invisible mechanics that eat away at your returns over time without you even realizing it. One of the most underestimated, yet absolutely critical, components of investing in gold through ETF is the cost structure. Because, unlike physical gold, where you worry about premiums and storage, or futures, where you're exposed to roll costs and leverage risks, Gold ETF introduce a more subtle form of erosion, the annual expense ratio. And when we're talking about cost efficiency, three ETFs stand out: IA, U, SGOL, and BAR, not just because they're low cost, but because they're structurally sound, precise in their exposure, and positioned for long-term compounding. Let's start with IAU. This is a fund that's been designed for scale. It's one of the most liquid gold ETF in the world, with billions in assets under management and decades of track record. What makes IAU especially compelling is that it charges only 0.25% annually, significantly lower than the more well-known SPDR Gold shares. That difference of 15 basis points might not seem dramatic on day one, but over 10 years, it becomes undeniable, especially in environments where gold returns are moderate or sideways. Every fraction of a percent matters. If your gold ETF is costing you more in fees than the inflation rate you're hedging against, you're compounding in the wrong direction. IAU avoids that trap. It gives you clean exposure to physical gold held in vaults, audited and allocated, while keeping your fee drag minimal. That creates an environment where the majority of your investment is doing exactly what it's supposed to do: mirror the price of gold without unnecessary friction. Then there's Escalabidin physical gold shares. At just 0.17% annual expense, it's one of the most cost-effective vehicles on the market. But SGOL isn't just about low fees, it's about precision. The gold it holds is stored in Swiss vaults, which appeals to investors who value jurisdictional security and regulatory transparency. That Swiss angle isn't a gimmick, It's a structural design choice aimed at stability and neutrality. For many, it's not just about accessing gold, it's about accessing it through a system they believe won't be compromised under stress. And when you combine that kind of design with a near rock bottom fee structure, you get a product that stands out. It's for the investor who wants low cost, but also wants to know that the foundation beneath the asset is as sound as the metal itself. And finally, BAR Granite Shares Gold Trust. Like Escal, it boasts a 0.17% fee, but where BAR differentiates itself is in its agility. It's relatively new compared to IAU and SPDR, but that youth is matched by innovation. It was built for a new generation of investors, those who demand cost efficiency, but also care about clarity and simplicity. BAR provides transparent tracking, direct gold exposure, and efficient operations without layering on unnecessary features. That's what you want when your objective is preservation, not speculation. You want a vehicle that stays out of the way, one that doesn't chip away at your capital under the guise of management. BAR does that. All three of these ETFs, U, Escal, and BAR exist to serve a core function, deliver as much gold exposure as possible with as little drag as possible, and in a portfolio construction context, that's exactly what you need. You want your defensive allocations, your hedges to be lean. When you're trying to protect against inflation, central bank missteps, or geopolitical shocks, you don't want a product that siphons value off quietly in the background. You want efficiency, you want elegance, you want reliability. These three ETF give you that, but here's the larger point. Cost efficiency isn't just about lower fees, it's about enhancing return potential without increasing risk. It's about designing a portfolio where each component does its job with minimal interference. Gold, when allocated correctly, acts as a shock absorber. And when held through a low-cost, well-structured ETF, it becomes a durable layer of protection, one that doesn't bleed capital while it waits for its moment to shine. So when you're choosing your gold exposure, you're not just picking between tickers. You're making a strategic decision about how you want to interact with a core asset class in a world that is increasingly volatile, increasingly uncertain, and increasingly shaped by forces outside your control. Cost structure is one of the few things you can control, and when you understand that, you don't chase performance, you engineer resilience. That's what these ETFs offer, not glamour, not hype, just efficient, disciplined exposure to one of the oldest and most enduring stores of value the world has ever known. In the world of investing, very few things are what they seem on the surface. You might think you're holding gold, but what you're really holding is a complex interaction of price, currency, and policy. That's why understanding performance means going deeper than raw returns, especially for investors in Singapore or in any open economy tied to global capital flows. You must analyze gold through the lens of currency dynamics, because gold doesn't exist in a vacuum. It trades globally in USD. So when you buy gold from Singapore, you're not just betting on the metal. You're making a secondary bet on the US dollar, and that's a critical layer of risk or return that many overlook. In 2025, gold's performance in US dollars has been extraordinary. With inflationary pressures persisting longer than expected, central banks tightening then pausing, geopolitical tensions escalating in Eastern Europe and the South China Sea, and fears of stagflation reemerging, gold responded the way it often does under these conditions. It climbed. In USD terms, it delivered roughly a 31% return year to date. That's significant, It reflects a growing mistrust in fiat currency stability, particularly in the dollar, which, despite being the global reserve currency, is no longer immune to the consequences of prolonged monetary expansion. But if you're a Singaporean investor and you purchased a USD denominated gold ETF, say, SPDR gold shares on SGX in USD, you didn't pocket 31%. You made closer to 23%. Why? Because the Singapore dollar appreciated against the US dollar during that same period. That differential, the currency translation effect, ate into your return. And that's the real lesson. Your returns aren't just a function of the underlying asset, but also of the currency denomination you choose. You must factor in both legs of the trade. You're not just long gold. You're long gold in USD and short SGD, whether you realize it or not. Now flip that. Suppose instead you bought the SGE-denominated version of the same ETF. In that case, your exposure is hedged by the listing currency. You receive the gold price movement, but translated through the SGD. That shields you from dollar weakness, but it also limits your upside if the dollar strengthens alongside gold. There's no free lunch, only different trade-offs. One route gives you pure gold performance plus FX exposure. The other neutralizes currency movement at the cost of complexity. The decision depends on your macro view, your positioning, and your time horizon. Currency movements aren't noise. They are signals. They tell you where capital is flowing, what central banks are prioritizing, and how markets are pricing risk. The Monetary Authority of Singapore has managed the SGD exceptionally well, anchored to a basket of currencies and adjusted through a crawling band mechanism, not interest rates. That makes the SGD relatively stable, but it also means that when the dollar weakens globally, the SGD often strengthens. If your gold exposure is in USD, and that happens, your gains will be trimmed by FX headwinds. It's not enough to just ask, did gold go up? You must ask, in which currency? And what does that mean for me? That's why smart investors in Singapore are choosing ETF that provide both options, USD and SGD listings. This gives them flexibility to shift based on their macro thesis. If they believe the US will weaken its currency through deficit expansion or rate cuts, they stay in SGD. If they believe geopolitical shocks will drive global capital into dollar-based assets, they might shift to USD listings to amplify gains. The bigger point here is that performance is not just return. It's return net of friction, net of risk, and net of currency erosion. You have to step back and think in systems. Gold is a hedge, but if you're using the wrong currency wrapper, that hedge can be diluted. And in the long run, that matters because compounding isn't about what you make in any single year. It's about avoiding unforced errors that bleed away returns quietly over time. When you zoom out, what you're really doing is aligning your gold exposure with your world view. If you believe we're moving into a world of currency realignment, where the US dollar no longer holds its current dominance, where multipolar reserve structures emerge, and where inflation becomes structurally embedded, then you must not only hold gold, but hold it in a way that reflects that thesis. Your currency awareness becomes part of your risk management process. It becomes part of your alpha, and in that world, it's not just about owning the right asset, it's about owning it the right way, with the right wrapper, in the right currency, at the right time. That's how you stop playing the game everyone else is playing and start playing the game at a higher level. There's a difference between buying an asset and building a portfolio. Buying is transactional, portfolio construction is strategic. It's about engineering balance, resilience, and adaptability. When you're dealing with something as foundational as gold, an asset that exists not for excitement but for stability, the way you access it matters as much as the asset itself. You can't just think in terms of exposure. You have to think in terms of architecture, how access, cost, currency, and liquidity work together to create or destroy durability over time. Let's start with access. Not every investor is playing on the same field. Some are institutional, trading in blocks, concerned about execution slippage and custodial transparency. Others are retail, investing through online brokers, optimizing for simplicity and frictionless transactions. What unites them is the need for precision. Gold ETF provide that, but within that structure, the choice between instruments, between SPDR gold shares, IAU, SGAL, BR shapes your exposure. SPDR offers dual currency listings in Singapore. IAU gives you S-based access with high liquidity. SGAL provides Swiss, stored gold with a low-cost base. BR aims for agility and transparency. The point is not which one is best universally, it's which one aligns with your access requirements. If you're in Singapore, having an ETF listed on SGX denominated in SGD immediately reduces foreign brokerage dependencies and gives you a smoother interface with your existing accounts that lowers barriers and enhances flexibility. Structure follows strategy. Cost, then, becomes your silent partner. Most investors underestimate how much cost drags on performance over time. A 40% fee versus a 17% fee seems marginal until you compound it over 10 years with moderate returns. In low-return environments, which are increasingly the norm as central banks exhaust their tools and growth slows structurally, every basis point matters. A higher cost ETF needs to outperform just to keep pace. So when you're evaluating instruments like SPDR versus IAU or BAR, you're really deciding how much friction you're willing to accept for the perceived advantages, like superior liquidity or broader institutional support. For some, those features are worth paying for. For others, particularly long-term holders with no need for daily liquidity, the lower cost option preserves more value. Cost isn't just an input, it's a risk, and like all risks, it has to be compensated or avoided. Currency, on the other hand, is often misunderstood entirely. People treat it like a secondary factor when it's often the primary driver of return variance. Gold trades in USD globally. If your ETF is denominated in USD and your base currency is SGD, you're exposed not just to gold's movement, but also to the FX dynamics between the two. If the dollar weakens, your returns take a hit, even if gold rallies. And if the dollar strengthens while gold stagnates, you might still see gains. That embedded currency exposure becomes a lever, one that amplifies or suppresses your intended allocation. ETF that offer SGD-denominated listings can neutralize that variable, giving you pure gold exposure without the FX noise. But even that's a choice. Sometimes you want the FX exposure. Sometimes your view on the dollar or your broader portfolio positioning demands it. The point is to make that decision consciously. You don't ignore currency, you use it, you position around it, because in a macro-driven environment, currency is never neutral. Then there's liquidity, the lifeblood of execution. You may hold the right asset in the right structure with the right view, but if you can't exit efficiently, it can all unravel. That's where product size, trading volume, and bid-ask spreads come into play. SPDR Gold shares, for example, has deep liquidity globally. IAU offers similar volume with a lower cost, Bar and Escal, while smaller, still provide adequate liquidity for most long-term investors. But you have to know your size, your timeline, and your exit horizon. Liquidity isn't about how easy it is to buy. It's about how costly it is to sell under stress. In moments of crisis, spreads widen, volume thins, and inefficiencies spike. That's when the structural design of your ETF proves itself or fails. If your position is large relative to the fund's average daily volume, or if you're trading in a stressed environment, liquidity becomes a risk you didn't price in, and that can be costly. So the strategic question isn't just, which gold ETF should I buy? It's how do I hold gold in a way that serves the broader architecture of my portfolio? That means choosing instruments that reflect your goals, whether that's long-term preservation, short-term defense, currency hedging, or cost minimization. You want gold to do its job, to hold value, to provide ballast when risk assets falter. But to unlock that utility, the structure has to align with the function. And that's the real insight. The best portfolio isn't the one with the most return in any one year. It's the one with the least regret across time. That comes from balance between access and control, cost and efficiency, currency and conviction, liquidity and resilience. When you get that balance right, you don't just survive volatility, you benefit from it. That's how real portfolios are built. The world of investments is a delicate interplay of global forces and structural mechanics. When you invest in gold, you're investing in more than ounces. You're investing in belief, policy, inflation, and liquidity. Singapore offers powerful tools to translate those forces into performance. Make your choices reflect not just insight, but your conviction. That is how we win. That is how we grow. And that is how we watch Gold ETF in 2025. Thank you.